A shocking billion-dollar crash in commercial real estate has unleashed a banking panic, threatening to plunge major cities into economic chaos and kick off the next global financial crisis. Stay tuned. Plus, tonight's show is brought to you by Upexi. You can find them on the NASDAQ and symbol UPXI, and they're building the next generation of crypto treasury model. And since we last featured them on their show, the stock doubled in value, and now the chart is suggesting it's setting up for another big move. Don't miss this the second time. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's turn to Bloomberg, because we're finally starting to see what I've been warning about is coming. Well, it's here. The first domino has now fallen. As a collapse in value of Denver office tower to hit bond investors, and I want you to understand that this is just the beginning, because I'm going to show you how the small and mid-sized regional banks are exposed here, how this is going to hit their balance sheet, and how it could trigger a repeat of what we saw with Silicon Valley Bank, except this next time it's going to spread to every major city and could kick off the next financial crisis. Investors who piled into the safest portion of a $277 million commercial property bond, that is the first tranche. If you remember going back to the global financial crisis, the bonds were carved up and sold off in tranches. Now what you're seeing is the highest level of tranche here is going to take a hit, and this is something that should not happen. I'm going to show you just how exposed those investors are and how big of a haircut everyone else is going to take. And that was tied to a Colorado office tower and is facing the prospect of steep losses after the building was reappraised at a fraction of its former value and interest payments were cut. And what we're starting to find in the commercial real estate sector is something that none of the banks want to happen. It's called price discovery, because we already know there have been buildings that have sold below their blown value, and the risk is at some point we're going to find out the true value of these buildings, and next thing you know, the banks are going to take a hit, investors are going to take a hit, and right now, at Denver, this is the epicenter. We're finally starting to see the first domino fall. The commercial mortgage-backed security is backed by the mortgage on the 52-story Wells Fargo Center in downtown Denver. The more than 40-year-old building's value was recently reassessed at $115 million. Get this, down 76% from when the debt was sold back in 2019. And that is a staggering hit. And this is not going to be a one-off scenario. As we look all around the country, we're going to see building after building get reassessed. Investors are going to get wiped out, and banks are going to take a massive hit. Now, again, you think what happened during the global financial crisis, the same thing happened with real estate mortgages. Now we're seeing it at the commercial real estate level, and this is one that's all centered on the small and mid-sized regional banks. They're the ones outside of investors who are holding this debt, but there's something else they're doing that's putting them at a massive level of risk here. You're not going to believe what's coming for them. That's left even the once AAA portion of the bond underwater. That means, again, that best tranche, while buyers of the lower ranking debt are likely to be completely wiped out. And this is staggering because we have not seen this. Now, what I want you to understand is this debt, it's owned by major mutual funds. It's in 401ks. It's everywhere. And the problem is, it means a lot of Americans own this, but it's how the banks are structured here. It's the risk that the banks have that could not only trigger another bank run, but an all-out liquidity crisis. And these investors are likely to get wiped out when the building is sold, and this is based on a key industry metric known as appraisal reduction amount, or ARA. And you're going to hear a lot more about this in the years to come, because one of the issues we've been facing here is the delinquency rate on commercial real estate has been rising. It's been rising at a staggering rate, and there's a massive amount of commercial real estate out there that's at risk here. And if you really think about why, is the economy changed after the pandemic. The work from home movement, the hybrid work schedule, the need for all of these buildings has declined, and the demand for more modern buildings went up, but there's a lot of older buildings now that are going to find themselves in default, and this is going to hammer investors. It's going to lead to people fleeing out of these investments like crazy and leave the banks holding the bag. It's a stark reminder that for a swath of older U.S. office towers lying increasingly empty since the pandemic ushered in the work from home era, the The time is running out to lure back tenants. And that is the big issue here, is even though some companies are recalling their employees back to the office, there isn't enough people to fill all of these office buildings. So what we're seeing here at this Wells Fargo building is only the beginning of the first now domino to fall. We're going to see a lot of buildings have their value written down, and you're going to see investors one after another get wiped out. But something we think is poised for a massive gain is already, since the last time we featured on our show, jumped over 100%. That's the stock for our sponsor of today's show, Upexi. Again, you can find them on the NASDAQ under symbol UPXI. Because on this red candlestick was the day we featured them on our show. The next day it opened up and then the stock took off from there. And I'm going to show you at the end of the show why this next setup could send the stock back to the recent highs and then potentially break out from there. Again, everything you need to know in the pinned comment and description below. Because when we take a look at who holds this debt, well, it's a lot of investors and a lot of big ones. How about Fidelity? PIMCO, Western and Southern Financial Group were among the largest holders of the Wells Fargo Center tied bond in recent quarters, meaning these things are everywhere. They're in IRAs, they're in 401ks, they're all over the place. And that means a lot of people are own this stuff and they don't even realize it. But when this starts getting sold and written down, people are going to find out. They're going to dump these like crazy. And we already know what happens when people hit the exit button. Prices come crashing down even more. But if we want to talk about the risk here, well, right now there's about 600 to 700 billion of commercial real estate debt out there. It's a massive amount. And again, this is enough to trigger an all-out crisis for the banks. But let's talk about investors first, because when we talk about getting wiped out, in this case, when we look at the bondholders, that first tranche, they're going to take an 18% hit. But how about everyone else? Could you imagine buying a AA rated plus bond? This was the original rating, and facing a 100% wipeout. That means everybody else is going to lose everything on this. But again, this isn't an isolated incident. This is the first domino in many older buildings. You're going to see this one after another. They're going to get written down, they're going to get sold, and people are going to get wiped out. And then you're going to find out that the banks are holding a major piece of this, and they're going to get a hit next, and that's going to lead to a massive liquidity crisis. And this trend is expected to continue and likely be exacerbated by the growing number of distressed assets with maturing debt that will be ultimately put up for sale. And so there you have it. What you're seeing is a lot of these buildings are going into delinquency. They don't have enough tenants to support the mortgage, and eventually they're going to go into default. And what happens here is you get distressed sales. And this is where you find out the real value of your property. Remember, we talked about this same issue happening in China with the property developers. They were behind on their loans and they got taken to court by the investors. And the next thing you know, the investors realized that they didn't have the money to pay the debt. And if this thing continued into liquidation, they were going to get completely wiped out. Same thing is happening here in the US. Again, this is the first domino of many that are likely to fall, because the issue is all about delinquency rate. Now, if we look at this at commercial real estate loans, you can say, well, it's at a relatively low level. Well, at least the last time the government reported it, the actual levels are somewhere between 5.5% to 6.5% of all commercial real estate debt is sitting in some phase of delinquency. And again, this is the risk here, because nobody's paying attention to it. And right now, again, the first one is starting to fall. As investors get wiped out, the word's going to spread like crazy and people are going to go running. But how does this impact the banks? Well, this is where it's interesting. We do know a lot of these mortgages are originated by the small and mid-sized regional banks, but that's not the whole story. As of 2025, U.S. banks held approximately 100 to 150 billion in commercial mortgage-backed securities, meaning they're holding this debt, and for a really good reason they're holding it, because it's never meant to default. Remember that high rating on that tranche? Well, it has everything to do with why banks are allowed to hold it and want to hold it. And that represents about 2 to 3% of total bank assets for large institutions. And here's where the risk is at. Again, think back to Silicon Valley Bank, a higher share, up to 5 to 10% for regional banks. So the issue we had going back to Silicon Valley Bank is we saw that they needed liquidity and couldn't sell assets. So what happened? The Fed steps in and says, look, we'll do an asset swap for cash. We'll get you through this and then straighten things out. Here's the real issue. These banks are going to take a hard loss. They don't have the ability to deal with that. And losses in AAA rated commercial backed securities, like those tied to the Denver office tower, are alarming because banks often hold these, quote, safe securities to meet regulatory capital requirements. So they willingly chose to do this to meet the regulations the government said they had to meet. And now they're facing the reality that they're going to get written down, they're going to take losses, and they're in no position to do this. As more dominoes start to fall and consumers start to figure this out, watch money flood not just out of these investments, but out of the banks. But it's not just the U.S. This is going to spread all over the country. We know that. But it's also going to spread all over the world. Let's turn to Germany. Let's start with their factory sector because I wanted you to see what's going on there and how it's impacting their commercial real estate sector. As German factory orders fell unexpectedly amid pre-trade deal flux, well, we know demand is dropping, and well, it certainly did. New business fell 1% for May compared to an estimate for 1.1% gain. In fact, the statistics office sharply revised the previous month's result, which now shows only a 0.8% drop, suggesting things did improve briefly, but then they turned back down. And here's the issue here, is it's going to get worse. So what you're seeing in the U.S. commercial real estate place is a lack of demand for buildings. And why is that? Because the economy is slowing down, people are working from home or on a hybrid schedule, so there just isn't the demand. But when you look around the world, this is affecting every business. As demand goes down, it's not just a need for buildings, it's a need for factories, office space, everything is dropping. Given the persistent high level of trade and geopolitical uncertainty, it comes as little surprise that order intake remains subject to strong volatility. The industry is likely to face subdued foreign demand in the future due to higher tariffs on exports to the U.S. that look to be permanent. And even if they're not permanent, it doesn't matter here because what's happening here in the U.S. with our commercial real estate is part of the problem that's plaguing the German automobile market. Think about it. People aren't commuting to work. If they're not commuting to work, they're not wearing out their vehicle, they're not needing to buy it. And how about the baby boomers? They love buying luxury cars, but most of them are now retired. And they went from owning about 2.5 vehicles, and depending on where they're retired, maybe they live in the villages, well, they only need maybe 1.5, and that half being a golf cart. Of course, that's the issue here, is the demand for vehicles are going down. And this is something outside of the tariffs is impacting Germany. Well, if their demand drops, then what happens to demand for real estate? Well, it goes right along with it. And yet the Bundesbank is confident that growth momentum will eventually pick back up. In June, it predicted expansions of 0.7% next year and 1.2% in 2027, with volatility prevailing in the near term. And why are they so confident? Well, it's not because they're actually confident. It's because they've realized that if the economy doesn't turn around and things don't get better, there's nothing they can do. Think about this. If any central bank was to cut rates 0.25% or 0.5%, do you think that's going to starve off what's going on in the commercial real estate space? Do you think it's going to fix the issues with that Wells Fargo building? It's not. It's not going to change demand for automobiles for German manufacturers. It's not going to change anything. So all they have right now is hope. Because if it doesn't, well, we're all going to find out once again the central bankers are playing chase and have no power. Because what's coming is Germany's insolvency tsunami. It's a structural breakdown is now underway, and you can see as their economy shrinks and demand goes down, it is going to affect all kinds of businesses. The death spiral in German businesses has reached dramatic proportions. According to the Leibniz Institute for Economic Research, the second quarter of 2025 saw the highest number of insolvencies among partnerships and corporations in 20 years. And so you think, what happens when businesses go insolvent and fail? Well, they don't need office space, that's for sure. Despite a decline in June, the trend remains. Germany's economic substance is eroding, and with it, the nation is quietly bidding farewell to its prosperity. That's exactly what we're going to see happen here in the U.S. As these buildings get written down, there's a lot of prosperity that was tied to their values. And I also want you to think about this. What about the governments who generate their tax revenue off the value of the buildings? Well, as they get written down, that means their revenue is going to drop. So we're seeing this happen in Germany, but we're also seeing it happen in China with their property sector. What you're seeing here is slowly, one by one, dominoes are just starting to fall, and what is exposing is a massive global financial crisis. Altogether, 4,524 company insolvencies recorded in Q2, a 7% rise compared to Q1 2025, and yet the Bundesbank is hopeful that things are going to turn around, whereas businesses in Germany are leading into insolvency, they're going to lead into default, and next thing you know, growth and inflation expectations are going to come tumbling down, which is exactly why Wall Street's betting on that, as bets on Fed rate cut are sweeping through the U.S. bond market. But hang tight, these are the two guys that are going to deal with the next financial crisis. That's right, Fed Chair Jerome Powell and Treasury Secretary Scott Bessent. But I want you to see the Fed's behind the curve every time. Let's take a look at the federal funds rate in red against the delinquency rate on consumer loans. And what do you see? The delinquency rate rises, telling you very clearly what's going on, that the economy is slowing, that consumers and businesses are under financial stress. And what happens in every time? The Fed's raising rates. You see it every cycle. The Fed's raising rates until they realize that the delinquency rate is not turning around, and then they start massively slashing rates in a huge way. And all this is setting up for what we're seeing with this Wells Fargo building is the beginning of one of the first dominoes that fall that's going to trigger a massive banking panic, could trigger an all-out financial crisis. But something we're very bullish on, and that is the stock for our sponsor today show, Upexi. You can find it on the NASDAQ on the symbol UPXI. Everything you need to know in the pinned comment and description below. Upexi is a forward-thinking public company building a treasury focused on Solana, a high-performance blockchain that's designed for mass adoption. With $331 million in Solana holdings and a $300 million market cap, Upexi trades at just 0.9 times NAV, while peers trade at 1.5 to 2.5 times. That's like buying dollars for 90 cents, which is part of the reason why we're so bullish on their stock. Solana launched in 2020, offers ultra-fast, low-cost transactions with this proof-of-history technology, making it a leader in active addresses, daily transactions, and decentralized exchange volumes. Its robust ecosystem supports finance, gaming, AI, and more. And Upexi's strategy provides crypto exposure through familiar equity structure, improving on MicroStrategy's playbook by aggressively acquiring Solana to capitalize on its growth and enhance shareholder value. And Upexi recently acquired $100 million of discounted locked SOL tokens in August of 2024, added more in August of 2024, demonstrating its commitment to building a substantial Solana treasury at attractive valuations. Upexi's capital markets flywheel leverages large-scale, accredited capital raises to acquire and hold Solana, aiming to maximize value while employing risk-prudent practices like native staking and validator diversity. And with seasoned executives that focus on operational excellence, Upexi bridges crypto and traditional finance, offering a compelling opportunity to participate in Solana's growth. Let's take a look at the charts, because this is quite an impressive setup here that we're looking at. Let's go back to that original time we featured him on the show the very first time, and then the very next day, the stock opened up a little bit and then took off. More than 100% rally there. Then it pulled back and is setting up here for another move. And how do we know that? Because if you look at the 10-day volume profile, you can see buyers are putting in support here, setting up another potential big move in Upexi stock. Visit upexi.com to learn more about how Upexi is positioned to capture value in the expanding crypto market with Solana at its core. And be sure to check them out on the NASDAQ on symbol UPXI. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.